Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. We've just had Canada Day on Friday, and today's July 4th, which is, of course, Independence Day for the U.S. There's fireworks in the gold stocks today, and I thought none other better to have on than David Skarica, my good friend. Unfortunately, I'm not recording from Eleuthero, where David resides in the Bahamas today, but we're doing this virtually. David, welcome back to the program.
Yeah, and actually, I don't know. I always tell people that, thanks for having me, but the British must have been sleeping or maybe couldn't take the heat in the summer, because actually Bahamian Independence Day, I think it's July the 10th. So it's kind of funny, right? Because like these Independence Days are all within like 10 days each other in the first half of July, right? So
quite a coincidence there. Well, David, last time we had you on, we discussed a few different things, one of them, though, being the gold and precious metal stocks, which I believe was right at the very early stage of this bull market before we could quite say that it was a new bull market. At this point, it would be hard to contest that we're in anything but a new bull market in the gold stocks. Why don't we start there and talk to us a little bit about what you're seeing in the space?
Well, yeah, I think we totally are, because I've been, I'm a little older than you, so I was around for the start of really this gold, and I still think we are in the super cycle for gold, even though we saw this huge decline in the gold stocks and the price of gold itself in the last 4 to 5 years. But, it's very similar to the 74 to 76 decline in the 70s before the huge move up from 76 to 80. Very, very similar, almost identical percentage decline in the price of gold itself. So what I think, though, is that the stocks really overshot to the downside. George Soros has a theory called reflexivity, which means that markets tend to overshoot in either direction, and they're actually not efficient. And I tend to agree with that more than these, so-called efficient markets. And we saw the gold stocks fall. The HUI went down to 100, and they're already up 150% from their lows. Now, granted, that's a very depressed low, and we're still roughly 60% off from our highs. So, we still have a long way to go back to those highs, which is great for investors who say haven't, gotten in yet. And we'll talk about the type of securities I think people should be in right now. But anyhow, I think we're very, very early on. This is very similar to the rallies in 2009, in 2001 or 2003, early on in the gold, cyclical moves, that could take it up, hundreds and hundreds of percent. And for example, actually the thing that looks most similar to me is, or the years that look most similar to this to me, is 2003 and 2009. And in each case, you're coming out of, like, say, a consolidation or a decline, and then the gold stocks essentially went up those years with no real huge pullback. So everyone was waiting for this seasonal pullback, which usually occurs from about May into the end of the summer in the gold stocks, and that's not happening. They're continuing to break out, and I think that's kind of where we are now from a seasonal point of view. We're trading more like 03 or 09, which is great, because really what should happen is you'll see these little consolidations that last a few weeks or a month, and then you'll just continue to go to new highs. And with the economic backdrop of, the central banks are now, especially after Brexit, are going to continue to be very, very dovish, very, very loose in their policy. And, and with really the stock market now in a 2-year trading range in the United States, and a lot of other markets are in corrections or bear markets, where you had equity markets really performing poorly, but gold and gold stocks are really the only sector going up in a significant bull market. And I think we're beginning to see that now. Even though we haven't seen a large decline in the equity market now, most markets have now done nothing for years. And the gold and gold stocks in the last 6 months are really the only market that's in an out-and-out bull market.
Well, let's just look today. We've got some phenomenal movers. Just looking on the list of stocks that Palisade owns, and I know there's some crossover here. We've got Miranda Gold up 50% on the day. Galani Gold, a stock that you've been championing for quite a while, is up 60 to 90% today. Several other stocks up 25, 30, 40%. These are the type of returns that are unheard of in any other sector. But you can have these type of returns day after day. How far into the bull market are we? You're saying this is just the beginning, but it feels like such powerful gains have already been made. Should investors start to get worried?
No, you're coming off very depressed levels. Like, for example, you talked about Galani Gold. this is a stock that at one point was, trading north of $1 a share back in 2011 at the top of the bull market, and went down to, 2.5 cents a share. So go from 2.5 cents to 8 cents. That looks like a big move, but it's still pretty cheap. And what I really love about Galani, this is my favorite model for early in a new bull market. And this happened with a company I invested in called Avion Resources, which was taken over. But Avion was very similar to Galani. They were both in Africa, different countries, but both in Africa. Both had former producing mines, which, the former owners had not really operated that well. And then both were trying to expand the production and keep the costs under control. And Avion, when I invested in it or put it in my newsletter in 2009 at 6 cents a share, went to $2, and then eventually was taken over for 80 or 90 cents. The only reason Avion fell, it was in Mali. And in Mali, there was like a coup in the government, and that, just hit the stocks because of the political uncertainty and nothing really to do with the mine. But anyhow, Galani, it's the same thing. They just announced that they tripled their production quarter over quarter, more than tripled. And the stock is moving on that news. And that's my favorite model early in a bull market. You get a producing mine, a small producing mine where you can expand the production. So you've got the leverage from the increase in the gold price, plus the leverage from the increase in production, and especially if the costs can stay under control. That is where you can kind of explode to the upside. And one advantage you have with the strength in the US dollar is in these countries, their currencies were depreciated against the dollar, and because their costs are in the local currency and they're getting even more of the local currency in terms of the gold price as their currency devalues, that can make these stocks even outperform. If you go look, for example, in the early 2000s, the South African rand collapsed in 2001, and gold moved, slowly higher from about 250 to, 350 an ounce in 2001, 2002. And the South African gold stocks went crazy because the profits just got leveraged like crazy as they, have fixed expenses in their local currency and then are getting even more rands for their gold, et cetera, et cetera. So really a lot of gold mines that are in Canada, that are in Australia, that are in Brazil, in countries where the currencies have gone down a lot, they will probably perform even better as well. But again, I like this model. We have a small producing mine and you can expand it, and those are the stocks that tend to have the leverage in a bull market. The classic example too would be Eldorado. It was a smaller mine when the last cycle started in 2001, and that was a stock that absolutely exploded over the next 10 years.
And David, tell us, do you see any more opportunities in the gold and precious metals space in particular, and then as a wider scope, what else you're looking at?
Yeah, well, the thing is, even though a lot of people will be scared away from juniors, thinking they're penny stocks, they're high risk, I've learned, I've had nearly 20 years of investing experience, even though I'm young, because like yourself, I started young. And the thing is, I've learned that in these gold cycles, these junior mining companies is kind of where you want to be, especially earlier in the cycle. Now, they may lag a little bit. They may not, keep up with the HUI or the gold indices in the first inning, but once you mature, they tend to really outperform. And really, risk is a function of price. So we were talking about Galani. At 4 or 5 cents, Galani did not have, had very little, limited downside, right? So the stocks I'm looking at right now, I've got about 5 or 6 juniors that are on my list. And by the way, I'm starting a promotion for my newsletter. We'll talk about it at the end of the podcast, but you have the ability to look at these stocks if you sign up for my promotion. But anyhow, I've got about 5 or 6 junior stocks, which I think you can go out and buy today. They're stocks that haven't moved. They have quality managements. They have good assets. And really, you could go out and buy them today. Whereas, the senior gold producers, Yamana, Eldorado, these companies, I think I feel a little, considering you could have bought them so much cheaper 6 months ago, I'd be a little more apprehensive about buying these companies at the moment, where I think these junior miners are really a great place to be. And if you're in early enough in the cycle, you can make good money. And then, of course, I also tend to buy some private placements where you get the warrants attached, and that almost gives you an extra kicker as well. So I think right now is really the time in the next 6 to 12 months to be positioning yourself in the junior miners, because these moves in the junior miners typically last 3 to 5 years, and we're only 6 months into it. And, of course, in 2000 and 2001, the move actually lasted almost 8 years into the first half of 2008. So really, we have the opportunity to, have anywhere from a 3 to 7 year bull market. but let's just, err on the side of caution and say it's 4 years. So right now, entering these stocks, getting the warrants, buying these stocks cheap. If you get investments in 20 or 30 of these companies, you're going to do really well, because probably 5 or 6 would really blast off. And the advantage they have with people like yourself and myself is we tend to, I can get rid of the crap, and I can invest in the quality stocks with the quality managements. And being in that sector for almost 20 years, I think I have good connections in the industry and are able to just invest in good managements.
Well, gold and precious metals is one leg to your stool that you've been talking about. You've also got 3 other areas that you're looking at. You've been very vocal about your strategic shorts, which have played out quite well over the last year. You've also started discussing the bond market, which you see as going parabolic in a final move. And it may be a consequence of a potential sell-off, which we haven't had yet, would be the potential to buy cheap stocks. Can you talk to us a bit about those 3?
Well, in terms of the stock market, to talk about shorting, I think one thing that's unique about now, as opposed to, say, like 2013, when the market was just going straight up with no corrections, is at that time, 2013, bonds sold off very hard that year. Gold and precious metals did very poorly that year. Well, now we have gold and precious metals breaking out. We have bonds acting very well. And I think it's like those markets telling you that the equity markets, which is very, very, manipulated by buybacks, by cheap money, people thinking that, this stock yields 3%. I'd rather have that than the 10-year bond, which yields 1.5%. So, they're distorted. But I think that those 2 markets are telling you that the stock market is at an artificially high level. But as you said, what I try to do in shorting is, I do have some of the ETFs that are inverse to sectors in the market, but I really try to find strategic companies which I feel can fall a great deal. So these would be companies with increased competition in their business, declining business models, overvalued. And also I like to find companies that technically have a history of melting down 90, 95, and sometimes these companies go down 99% in a downturn and bear market. So, but the great thing about the gold and precious metal stocks going higher is, instead of this being a tool just to make money, which when I started in 2014, I was using it to make money because, gold stocks were dead. I thought the stock market was expensive. Now we can use it as a hedge, which is what it should be anyhow. It should be more of a hedge than your primary way of making money. So you don't have to sell your gold and precious metal stocks. You can use this, and if there is a big decline in the stock market and you have put options on a company that melts down, or your short companies that melt down, then that can protect any potential losses if there's a big decline. And if it becomes like the summer of 2002 or the fall of 2008, and the selling spills over into all sectors, this can really happen. Because one thing about me is I'm still a little worried about the base metals. I still see a very big chance that China will devalue their currency, which would be devastating in the short term for base metals, because China is still the biggest consumer of all these, even though the Chinese economy has slowed in its consumption of base metals. So a potential banking crisis in China and them having to devalue their currency could really give us the final way down in the base metals. So I think having shorts on companies that have exposure to debt markets around the world, because I think there's going to be big problems in European banks, or to the Chinese economy, is a way to kind of hedge these other bets that are long. And basically in a bear market, we don't have to be Kyle Bass. We don't have to make all this money in subprime when it melts down. All we really want to do is protect our money. And if we could just say lose 5% or become flat or make a couple percent while everyone else is losing 30, 40, 50%, then you have capital to work and buy stocks when they're cheap. And okay, this is this last segue into one of the last, another thing that I'm doing here is I have a watch list of about 5 to 10 tech companies, regular stocks outside of the resource arena. And what I feel with these companies, these are companies that are mostly already down 70 to 80% from their highs. And in all bear markets, you have these big meltdowns where stocks lose 90 or 95% of their value. It happened to Amazon in 2001. It happened to Crocs, the shoemaker, in 2007. It happened to Skyworks. That's a semiconductor company in 2001 as well, 2001, 2002. So what happened, though, is in the reflex rally, the Las Vegas Sands in 2009, is that when these stocks melt down 99%, when the ensuing rally comes and bottom comes, a lot of these companies can rally 500, 1,000, even 2,000%, 5, 10, 20 to 1. So I have this list that if we finally do get a tank in the markets, not only can I profit from being short or put options, I can like swoop down and then buy these 5 or 10 companies, which I think will be great value. And if I'm right, that selling does take down some of the base metals, I think a lot of the base metal companies will have those huge buying opportunities as well. And then the final trade we have is I really believe bonds are in a secular blow off here. If you go look at bond markets, they're interesting because they have really long cycles, 30 or 35 years. And the bond market bottomed in 1981. And before that, it topped in the late 40s. So that was a 30-year-plus-year bear market, now a 35-year bull market. And I think the central banks buying bonds, having negative rates. If you go look at the way that the TLT, which tracks the 20-year bond in the United States, has just started to trade straight up since about June or May, I think it's a sign that we're finally entering this final blow-off in the bond market. And if that occurs, these final blow-offs tend to be 6 to 9 months. So I think it could last until the end of the year. And then I think at that time, it will be an excellent opportunity to short bonds in Germany, in Japan, in the United States, in the UK, in Canada, et cetera, et cetera. Because one thing that's going to really work against the central banks is these negative rates are destroying their banking sectors. So they're going to have to probably get rid of the negative rate policy after this bust. I think it's going to be evident when the bust happens that the negative rates played a big role in the problems the banks have had. So that move out of negative rates could be the first trigger for the bond market sell-off. I don't think the selling will get bad for 2 or 3 years, but I do think that we could have a debt crisis sometime after that. Probably this downturn will be met not with QE, in the form that we've seen recently to jack stock markets. I think it will be QE in the form to have infrastructure programs, which is, by the way, another reason I want to buy the base metals if there's one more decline, because if you're rebuilding roads, you're rebuilding bridges, you're building high-speed train networks, that's going to be a huge demand for commodities, even the base metals, if that occurs. So, that's why I really like the base metals at some point if there's a pullback here in the coming months. But anyhow, I think there's a great opportunity shorting the bond market. And by the way, if you look at the last thing if you look at these parabolic blow-offs, 1929, 1999 in the NASDAQ, 1979 in gold, it's always the same thing. You've had this long-term bull market, and then the last 6 months, everything just goes straight up and blows off. And I really think we're seeing that in the bond market right now.
Well, David Skarica is the publisher of addictedtoprofits.net. As he mentioned, there's currently a promotion going on for his newsletter. A good focus on the gold and precious metals space and junior stocks, but also well-balanced thought process on looking at these strategic short positions and even looking at buying cheap stocks in the general equities when the day comes, which could be very soon. David, thank you so much for coming back on the program. Looking forward to getting back down there with you in person in Eleuthera and recording a video or in-person interview to update our audience here in a few months.
Yeah, thanks for having me.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?